Everybody's been so worried about what's going on with oil prices, the Strait of Hormuz, and the shutdown of this is going to cause oil prices to surge to 100. Two things have been happening. So Iran says, hey, we're going to shut down the Strait of Hormuz. Problem is they really don't have a navy anymore. So they're going to be relying on missiles and drones, and that's certainly a threat. China has come out and said, look, we need to keep that open. China is very dependent on oil that goes through the Strait of Hormuz. But the big problem has been insurance for the ships going through that strait, because Barclays and others have come out and basically said, yeah, we're canceling your insurance, or if you want your insurance, it's going to be like a 500% premium. Yesterday, President Trump came out and said, hey, we'll supply the insurance. So with that news yesterday, we've not really gone anywhere in oil prices. For the last couple of days, we're about $74 on oil prices right now. It spiked above 80 yesterday, sold off most of yesterday after that news. So oil prices at about that $74 level this morning. Things are starting to seem to be calming down here just a bit on that front. We'll see what happens. Obviously, if oil prices rise 10, 15%, that is going to have an impact on near-term inflation. We're going to see gas prices go up, those type of things. This is not a huge input into CPI. CPI is still driven by housing. So we may see an input in terms of inflationary pressures feeding into things like PCE, and also particularly prices paid and some of the manufacturing and services indexes where they're more impacted by fuel prices. So we are going to see potentially a little bit of a short-term uptick in inflation measures across the board, but that's only as long as oil prices remain elevated. Once this situation cools down, oil prices likely are going to fall probably back into the 60s. And important to remember is that out of all the oil that goes through the Strait of Hormuz, the United States is maybe 1% impacted by that. We are now a major exporter of oil. We have plenty of oil supplies here. I saw a lot of comparisons. This is like the Iran oil embargo back in the 70s. No, very, very different. Back then, we didn't have near the production capacity that we have today. Dependency on foreign oil was a lot higher than it is today. We can live without the imports of oil. They're still important for us. I'm not dismissing that at all, but we are not as vulnerable as we were back in the 70s. So try to just keep things in sort of just some level of normality. When you're reading headlines, be careful what you're reading.
As long as the conflict proceeds forward, the dollar should bid well, like we've seen over the last couple of days. And look, it's not going to go straight back up, right? But we've seen a pretty sharp increase in the dollar over the last few days. It's a flight to safe haven status. Obviously, if I'm a reserve currency manager and I'm holding reserves, I'm going to move my reserves to the area that's most safe, particularly during a period of conflict, and that's the dollar, because liquidity, depth, everything we've talked about before. So if this continues forward as a longer process, then the dollar should continue to bid here. But again, the dollar's trading at about fair value right now, but you should expect the dollar to bid better in periods of military conflict.
Catch me daily on The Real Investment Show. The link is in the description.